One of the biggest keys to actually making money with day trading is having a solid strategy, one you can stick to consistently, and that works over time. Here's the thing, most day traders lose money because they don't have that. Either they don't have a strategy at all and just keep jumping from one idea to the next, or worse, placing totally random trades, or they do have a strategy, but it just doesn't make money. So they keep trading with a losing plan until they're burned out and broke. I've seen it happen too many times, so I thought, why not make a video that can actually help people fix this? That's what today's video is all about. I'm going to walk you through my favorite and what I believe is the best day trading strategy I've discovered over the past 10 years of trading. It's a full tutorial, start to finish. Doesn't matter if you're brand new or already deep in the game. By the end of this video, you'll know the exact strategy, how to use it, and hopefully be one step closer to hitting your trading goals. If that sounds good, go ahead and hit that like button. And if you're new here, subscribe. We put out videos like this every week. And if you're already subscribed, welcome back. I'll see you right after the intro. Let's talk about what you really need to know. First, to actually make money with this strategy, you have to know how to spot trends on a price chart. That's a non-negotiable. So in the first part of this video, we're going to focus mainly on that, how to properly identify trends. Because if you can't read the market, the strategy won't work for you. But before we dive into the full lesson, I'm going to show you a live trade using this exact strategy with real money in a real market. I want you to see exactly how it works in action. After that, we'll break down how to read trends step by step, and then we'll go deep into the full strategy. So, if you already know how to spot trends after watching the live trade, feel free to skip ahead to the strategy section. All right, let's jump into that live trade. And I'll see you right after to walk you through how to identify trending markets the right way. All right, so here we are looking at the Aussie-Canada pair on the 5-minute chart. This is a trend continuation trade, and it's based on the exact strategy you're about to learn in this video. Now, at this point in the recording, I was already in the trade, so I had to wait and see if it would hit my stop loss or my target. But thanks to the magic of editing, you get to see how it played out right now. As you can see, this trade worked out beautifully. Price dropped just like we expected, hit our target, and gave us a solid 2.4 to 1 reward to risk ratio. That's a couple $1,000s made in just a few hours, all using the exact strategy I'm about to teach you. We're going to break this trade down fully later in the video, along with the entire strategy. But as I mentioned before, the only way you'll be able to pull this off for yourself is by knowing how to spot a trending market. So let's get into it. Here's how to identify trends on a price chart step by step. Just to be clear, this isn't just a day trading strategy, and it's not limited to Forex. I use this across all time frames and markets, stocks, crypto, Forex, you name it. Now that we've got that out of the way, let's break down the difference between major and minor swing levels. Nailing this is crucial if you want to spot trends the right way. Let's start by identifying major swing levels. These are found at the top and bottom of our impulsive moves. Here's what that means. An impulsive move is a strong price move that breaks through previous structure. In other words, it pushes past key resistance or support levels. The bottom of this impulsive move marks a major swing level. Likewise, the top of this impulsive move also marks a major swing level. Think of these levels as the start and end points of a breakout move, key points on the chart where big decisions are made. As price action continues, we begin to see pullbacks. The bottom of a pullback becomes another major swing level because it's the low point before the next impulsive move. Then, as price pushes upward and breaks through previous resistance, we establish a new high. This is the top of an impulsive move, and once again, it becomes a major swing level. We pull back again. The bottom of that pullback is another major swing level. As we continue pushing higher and break into new highs, we form another structure high. This too is a major swing level. There's no completely objective way to define these swing levels. And yeah, I know that can be frustrating. It's definitely easier when you have hard mechanical rules to follow. But after a lot of testing and experience, this is the method I personally use to identify major swing levels. It's the top and bottom of my impulsive moves. That's the key. It may not be perfect or purely objective, but it works with price structure and gives a consistent framework to follow. In a trending market, price action might move like this. It pushes up, pulls back, pushes up again, pulls back again, and so on. The key levels we focus on during a trend are the major swing levels. Here's what that means. Let's say we create a new high. According to our rule, once we break through that high, we need to watch the low of the previous pullback. If the market comes back down and breaks that pullback low, then we no longer consider the market to be in an uptrend. But if price stays above that low, like it does here, then we are still in an uptrend. And when the market pushes up and breaks into new highs, that's a strong confirmation that the uptrend is continuing. Identifying major swing levels in a trending market. In this scenario, the major swing levels would be our initial starting point, the low before the first impulsive move, the first new structure high, the pullback that follows, the next new structure high, and the next pullback. But here's the important part. You won't know for sure that a level is a major swing level until price breaks into new highs. That confirmation is key. A level only becomes a confirmed major swing level once the market proves its direction by continuing the trend. And that's totally fine. The reason we wait is because the level we're watching, the bottom of the pullback, is the level we don't want to see broken if the trend is still valid. We need the market to break into new highs before we can confirm that what we're seeing is truly the bottom of a pullback. Until that happens, there's no way to be certain because the pullback could just keep going. It could dip deeper, consolidate longer, or even reverse entirely. So we wait for structure confirmation. A break into new highs tells us the trend is intact and that the last low is now a major swing level. So with that in mind, you should now have a solid understanding of what major swing levels are. When it comes to minor swing levels, these are simply the smaller moves that occur in between the major ones. For example, this point would be considered a minor swing level. This one as well, minor swing. And this one here, another minor swing level. They're the in-between fluctuations that don't necessarily shift the overall trend, but still play a role in the price structure. In the context of a trending market, we don't pay attention to the minor swing levels. They're not used for decision-making in this type of analysis. Now let's move on to a bearish example. As we go through the chart, I want you to try something. Take a moment to identify the major and minor swing levels yourself. I'll give you about 5 seconds. Pause the video if you need to, and see if you can spot them before I point them out. Hopefully you paused the video and had a chance to mark out the levels yourself. Now let's look at how to draw out major swing levels in this bearish example. We'd start with a major swing level at the high up here. That's our initial point. Then the market pulls down. But what are we waiting for? We need to see an impulsive move that breaks previous structure. And now, looking at this strong move down, we can clearly see that it broke through a previous structure level. So this confirms it as an impulsive move and helps us define our next major swing level. So now we know that this is an impulsive move. Then we get a pullback, but remember, we don't know that this is the top of the pullback until what? Until we actually break through this support level. Once that happens, once price breaks support, we can now officially count this as a major swing level as well. This marks another major swing level, and we now confirm it as such once the market breaks through that point. From there, price continues to push down, and the next major swing level forms where this significant pullback begins. Next, we look for the top of that pullback, which would be right here. That becomes our next major swing level. Then comes the next impulsive move. And remember, an impulsive move is only valid if it breaks our previous major swing level. So, If we draw a line across that last level, you'll see that this next move breaks through it, which means this becomes our next major swing level. I know a lot of you probably marked this as a major swing level, but here's the thing. We didn't get a break of our previous major swing level right here. And because of that, there's no way we can count this as a confirmed major swing level. So this is how we would correctly draw out the trend. The top of the pullback becomes a major swing level. Then the market pushes down. But remember, to confirm the move, we need to break and close below structure. And right here, we do exactly that, break and close below, confirming the next major swing level. So now we've had a strong push down, and this marks our next major swing level. Now ask yourself, what's the next thing we need to see if this market is going to reverse? We need to wait for a break of this key level right here. Only after we get a clear break of that level can we identify the next major swing level just before the market pulls back. From there, we continue watching for new major swing levels step by step in order to accurately track and confirm the trend within any given market. Once again, there's no way to make this completely objective, and that's just part of the process. It's something you'll need to spend time learning and getting a feel for through experience. But let me show you an example of what I mean. We have a situation where this level becomes a major swing level. Why? Because it's the bottom of an impulsive move. We see a pullback, then a push down. That's our impulsive move. So the bottom of each of those impulsive moves is what we identify as a major swing level. Once we get this strong push up and break above this resistance, that confirms a key structural shift. With that break, this is definitely a major swing level, and so is this one right here. Now, in terms of a potential reversal, we begin to consider the market to be in a possible trend reversal, but only conditionally. We'll continue viewing it as a reversal unless or until the market breaks and closes back below this level. That would invalidate the reversal and shift our bias again. And with this being a confirmed major swing level, the next logical major swing level would be the bottom of the pullback, right? But here's the catch. We can't call it the bottom of the pullback just yet. Why not? Because we don't know for sure if it's actually the bottom. The pullback could continue further, and until we see a break into new highs, we can't confirm this level as a major swing level. It's all about waiting for confirmation. As you can see, the market eventually drops even lower at this point, so we still can't consider this the bottom of a pullback. Why? Because we haven't broken above this previous level yet. Until we get that break above resistance, there's no confirmation. And we have to wait and see if price will eventually push through that level. Only then can we confidently mark the bottom of the pullback as a major swing level. Once we get a break through that previous resistance level, we can confirm that we have a major swing level. And the fact that we only recognize it as a major swing level after the break is totally fine. Why? Because the sole purpose of identifying this major swing level is to confirm that the trend is still intact. We're not trying to predict. We're reacting to structure to stay aligned with the trend. At this point, since we've now identified this as a major swing level, we have our low to high structure in place. Once we see the break through this level, it confirms that we are still in an uptrend. No matter what kind of consolidation or smaller movements happen in between, the trend remains valid as long as we don't break below our previous major swing level. That swing level is our key reference point for determining if the trend is still intact. That's exactly why it's perfectly okay that we have to wait for a break of this high in order to confirm it as a major swing level. The reason we're identifying this major swing level is not for early entries, but simply to confirm that the trend is still intact. What matters is that price stays above this swing level. That's our structural guide. So, no matter what happens in between, as long as price remains above 1.2144, we can still consider the market to be in an uptrend. And that's how we use major swing highs and lows in our analysis. Hopefully that made sense and helped clarify the concept for you. Now, what I want to do next is walk you through a series of trending markets and show you plenty of real examples. The goal is to help you clearly identify trends in different market conditions so you can recognize them more confidently in your own trading. Let's jump into that now. All right, so here we are on the EUR/AUD 4-hour chart. And as you can see, in a real trading scenario, it can be pretty difficult to determine the overall trend of the market, especially in situations like this. Sure, you could say we're in a slight uptrend, but there's also a lot of choppiness and indecision in between. And this is the reality of the markets. It's not like what you often see on YouTube, where people show clean, obvious trends. That's usually cherry-picked. And I'm guilty of doing that sometimes too when I'm trying to clearly explain a concept. But what I've found actually helps traders more is showing real, messy, choppy examples like this, because that's what the market usually looks like. So let's draw this out using the rules we've established, starting from this point right down here. This is our starting point. From there, we get an impulsive move upward to a major swing high. Then the market pulls back, forming a swing low, and continues up again to create another major swing high. At this point, what are we waiting for? We're waiting for the bottom of the pullback to be confirmed as our next major swing low, and we can only confirm that this is the bottom of the pullback once price breaks above this previous resistance. That break confirms the structure and gives us our next major swing level. At this point, the way we would draw this out is by marking our next major swing low, which is right here. Then we look for the next major swing high. But remember, in order for it to count, price has to break and close above the previous high. We don't actually get that confirmation until right up here. So this becomes our new major swing high. Now, in terms of the uptrend, we know the trend is still valid as long as price stays above this key support level, our last major swing low. Pro tip while practicing: to help keep track of structure, draw horizontal lines at all your major swing lows during an uptrend and at all your major swing highs during a downtrend. This helps you stay aligned with the trend and makes the structure easier to read while you're still developing your eye for it. At this point, everything that happens between our new structure high and the start of the pullback is just part of the ongoing trend development. This would now be considered our next major swing level simply because we've started to pull back more than just a few candles. So after the breakup here, and once we see a clear multi-candle pullback, we can confidently mark this as our new major swing high. Now the market is pulling back, and everything happening in between is really just consolidation. Personally, I'm not trying to trade anything within this choppy zone. If we get a deep enough pullback, I might consider it. But that's not the point here. This isn't a lesson on trade setups. This is just about understanding and identifying trends. So in this case, why don't you take a moment and try to identify what our next major level would be? Looking at price right here, what would the next level be? It would be the bottom of the pullback, right? All of this movement in between is just consolidation. But more specifically, it's just a typical pullback in price. It's relief from the momentum we had after our new structure high. Once that relief is done, price pushes higher. Now ask, where do we get a break and close? It happens right here on these candles. Then what happens next? We start to pull back by a few candles, which means we now have a new structure high and a new major swing low. Hopefully you're starting to see the pattern. At the point we break and close above the previous high, we can mark out our new swing highs and major swing levels. Major swing, major swing, major swing, major swing, already circled and drawn, each one confirmed by structure and price action. We know this is a major swing level once we get a push-up followed by a break and close above our previous level. So the way we would draw that out is from the swing low up to the swing high. At the point where we close above this level right here, we can now identify that the pullback ended here, making this our new swing high. From there, we wait for the next move. We need to break and close above this swing high. Once that happens right here, we now know that the lowest point of the previous move is our pullback, and the break and close gives us a new major swing high. Hopefully, by now, this is becoming easier and easier. You're getting more comfortable spotting major swing highs and lows and drawing them with confidence. At this point, we've been following this trend all the way from our original starting point. And even though the structure may look a bit choppy, if you had been trading with the trend, you would have likely had 4, maybe even 5 winning trades before the trend started to break down. And that brings us to an important concept. Trends don't last forever. At some point, every trend will come to an end. So, how do we recognize that? Our first hint, the first real sign that a trend might be coming to an end, is right here. Here was our previous major swing low. Now, how do we classify this as a major swing low? Well, we had a pullback followed by a move to a swing high. But the only way we can officially label this as a major swing level is after we break and close above that swing high. Once that move happens, you can mark the level, use a horizontal line, circle it, whatever helps you clearly see it. From that point on, we are considered to be in an uptrend, unless this level is broken and closed below. And as we can now see, that's exactly what just happened here on the Euro-Australian dollar. Once this break happens, it's a clear signal from the market. It's telling you that a reversal is likely. We're now looking at a potential trend reversal. And after this break, we're no longer interested in bullish trades because we're no longer in a bullish trend. If you're trading with the trend, then at this point you stop looking for long entries. What do we need to see now? We'd need the market to come back up and break above this resistance level, just like this. Let me adjust the chart to show it. If that break happens, that would indicate we're back in an uptrend and we can start looking to buy pullbacks again. Or, alternatively, the market could continue downward and break below this support level. If that happens, we now have what I call a 1-2-3 reversal move. Once we break this major support level, also known as a major swing level, that would officially mark the beginning of a downtrend. So that wraps up the bullish examples of how to identify and interpret major swing levels. What we're going to do next is switch to a different chart, and I'll walk you through a complete bearish example of all of this. That way, you'll have a full understanding of how to recognize major swing levels and analyze trending markets in both bullish and bearish directions. Let's jump into the bearish example now. All right, so once again, with a bearish trend, it's easy to look at clean examples where the market is clearly pushing lower and say, okay, that's a bearish trend. But in reality, markets often look much more choppy than that, right? This is what a real bearish scenario typically looks like. It's messy, it's inconsistent, and it's hard to clearly identify major swing levels unless you have a defined set of rules. And that's exactly what I've been sharing with you throughout this entire video, my personal rules for identifying major swing levels. So let's break this down step by step. We'll start right here. This will be our starting point, our first major swing level. This area right here becomes another major swing level, and this here is our previous level of support. Now the question is, where does our impulsive move end? Let's figure that out based on the same rules we've been using. So what we're seeing here is a market that's pushing down. We have a major swing high to a major swing low. Then we start to see a pullback forming, and this is where it gets a bit subjective. I don't have a hard objective rule for what counts as a pullback. What I usually look for is at least 2 candles and some actual movement, not just small hesitation candles. For example, I'm not talking about 2 tiny candles like this. Those don't really count as a proper pullback. That's just brief indecision before continuing the move down. What I'm looking for is something that shows clear retracement, some distance, at least 2 decent candles that suggest price is actually pulling back before the next push. This is one of those areas where experience plays a big role. The more charts you look at, the better you'll get at recognizing real pullbacks in live conditions. This is one of the better ways I've found to identify a pullback objectively. So let's say this was our impulsive move and this is our pullback. What are we waiting for next? We're waiting to see this support level break and close below. Why? Because once that happens, 2 important things occur. 1, it confirms that we are officially in a downtrend. If this were a reversal scenario, this would now qualify as a 1-2-3 reversal move. At that point, we know for a fact we're in a downtrend. 2, this break also allows us to clearly define the swing level that the market must now respect to continue in that downtrend. That level becomes the line in the sand. If price comes back and breaks above it, the downtrend is no longer valid. Because once we get a break of this major swing low, we can now confirm that this was the top of the pullback. That top becomes our major swing level. And in a downtrend, it's a critical level that must hold. If that level gets broken, it signals a potential reversal. In our case, we're looking at a chart where the price doesn't break upwards. Instead, the market keeps moving down and pulls back, creating another swing high, a major one. We know it's a major swing high because the price pushes down and breaks below this previous level, our last major swing low. So, what this tells us is the price can't come back up and close above that major swing high. At some point, it has to close below this level instead. But let's say, for example, I can get the market replay to work right here. What we're doing when it comes to placing trades is this. We're looking for chances to go short or sell because we expect the market to keep moving down. As long as the price stays below this level, 1.0851, we're focused on finding setups to ride that bearish trend lower. So we're basically looking for short opportunities as long as we don't break above that level. As this pullback moves up, it gives us more chances to go short and follow the trend down. We'll keep doing that unless the market breaks above that key level. But so far, that hasn't happened. Instead, what does happen is we get a break and close below that same level again. That tells us the bearish trend is still in play and there's still downside momentum. Now we can also mark a new lower high, and that's important. If the market is going to stay in this downtrend, it should not break above that lower high. So here's our lower high, and this level has to hold if the downtrend is going to continue. But now, this is where things start to shift a bit. So what do we have at this point? We see a strong push down to a major swing low, but then we get a break and close above the previous swing high. What does that tell us? Basically, it shows indecision. The market doesn't seem to want to keep going lower anymore. We've talked about how charts reflect mass psychology, and this is a great example. Breaking above that last pullback shows us that buyers are stepping in. There's bullish pressure now. It's like the market is saying, hey, this price is too cheap. We think it should be higher. But at the same time, there are still a lot of traders who believe the price should go lower. And that's shown by the big move down earlier. So what does all this tell us? It's simple. Indecision. In trading, we call this kind of price action consolidation. And this is the first clear sign that the market is starting to go sideways instead of trending. And if you're a trend continuation trader, like we are, this is exactly the type of environment you want to avoid. Why? Because this is when most of our losses happen. When the market is stuck, unsure, and just moving back and forth without direction. So, the first step in spotting consolidation is knowing what trend continuation should look like. If you know that a certain level must not be broken for a downtrend to stay intact, then seeing it break tells you the market is now unsure. It's no longer clearly trending down. That's your cue to pause and avoid trading in that zone of uncertainty. So, once this move happens, here's what we do. We mark this as our new high, and this is our previous low. Now, before I take any trades in this situation, I need to see one of those levels break. Anything that happens between those two levels, that's just consolidation, just minor swing moves with no real direction. I'm waiting for the market to show me it wants to commit to one side, either up or down. And right here, it finally does. We get a clear break below that low, and that tells me we've got renewed bearish pressure. Now I can start looking for possible short trades again. That was a deep dive into how to spot major swing levels and how to use them to identify trends in any market and on any time frame. Yeah, it was a long section, but trust me, it's going to make a lot more sense now that we're moving into the actual strategy, so let's get into it. The strategy you're about to learn is all about getting on the right side of the market, and that's why understanding trends was so important. Here's how we're going to do it. We'll be using two time frames. First, we'll look at one time frame above the one we plan to trade on. That helps us see the bigger picture. Then, we'll use our main trading time frame. That's where we'll actually enter our trades. We'll break this all down step by step next. So here's an example using the Aussie-Canada AUD-CAD pair. The trade was placed on a 5-minute chart. And like I mentioned earlier, we want to be trading with the trend from the higher time frame. That helps us stay on the right side of the market. So how do we do that? If I'm trading on the 5-minute chart, then I look one time frame up to the 15-minute chart to figure out the trend. You can see all the time frames I use right here. I always follow this simple rule. Go one step up. If I'm trading on the 15-minute chart, I check the 1-hour chart for trend direction. If I'm on the 1 hour, I look at the 4-hour. And if I'm on the 4-hour, I move up to the daily chart. I usually don't go higher than the daily. That's more than enough to understand the bigger picture for this strategy. That's the exact time frame setup I personally use, and it keeps things really simple. So let's go back to this chart. What trend are we in here? You can probably already tell since I've drawn it out, we're clearly in a downtrend. Here's why. We have a starting point right here, which marks one of our major swing levels. Then we get another major swing level, and another, and another. Each one continues the pattern. We have a lower high and then a lower low, both of which are also major swing levels. That's what confirms the downtrend. No doubt about it. So if I want to trade with the trend based on what I see on the higher time frame, then I should be looking for short trades only. Now, the first step in this strategy is making sure we're aligned with the higher time frame trend. That's how we stay on the right side of the market. Once we've done that, here's why understanding major swing levels is so important. When a major swing level gets broken, that's the key level we want to pay attention to, because that's where trend continuation often happens. So, as the market pulls back up into this area, that's exactly where I want to start looking for opportunities to jump in and ride the trend back down. And you'll see, this setup works really well, over and over again. If we look back at the previous major swing level, you'll notice something important. Yeah, I widened the zone a little bit. But remember, these are zones, not just perfect lines on a chart. And look at what happened. The market pulled back right into that zone, then pushed down and broke through another major swing level. That's exactly what we expect to keep happening until the market tells us otherwise by breaking through one of those key levels, our resistance zone, and possibly starting a reversal. So, now that we've covered all that, here's what I do next. After I've identified the trend and spotted the last major swing level that was broken on my higher time frame, which in this case is the 15-minute chart since I'm trading on the 5-minute chart, the next step is super simple. I drop down to the 5-minute chart and then I just wait. I wait for the market, whatever asset I'm trading, to pull back up into that zone. And once it gets there, I look for signs of rejection. And don't worry, I've got very specific rules for spotting rejection. I'm not just going to leave you hanging when it comes to finding an entry. The whole point of everything we've covered so far is to set you up with a clear rules-based strategy. Remember what we said at the beginning. If you want to be a successful day trader, if you want to actually make money doing this, then you need a strategy that's built on rules. Rules help you stay consistent, and consistency is what leads to real results over time. This exact strategy is one I've used for almost 10 years, and it's been proven to work for me again and again. Best of all, it's structured in a way that makes it easy to follow and stick to. No guesswork, just clear steps. All right, so let's go over the rules. Here's how the strategy actually works step by step. Rule number 1, start with the higher time frame trend. Make sure you're trading in the same direction. Rule number 2, find the last major swing level that was broken. That's the key zone you're watching for a pullback. If you've been following along, you already know how to do both of these. Rule number 3, look for rejection. And here's how we spot it. We want to see the market come up, test a high, and then get rejected by turning back down. This forms a really simple pattern called a double top, and it's what I use as my main entry signal. Now, one extra detail I always look for. After that second top, I want to see a red candle form. That's the sign of selling pressure stepping in. So, first test of resistance. Second test, red candle pushing down. You'll actually see all of that on the chart in this trade we're looking at right now. Okay, so here's the market right at the moment I entered this trade. Everything was lining up perfectly based on the rules we just talked about. We were in line with the higher time frame trend. We were at the previous major swing level that had been broken. Now, remember what I said I was looking for? As price pushed up into this zone, we got a high, but the market wasn't ready to move lower just yet. And here's why. It actually broke through that high and made a higher high. So at this point, I'm not interested in shorting. I'm waiting for real confirmation before I jump in. Do we get that confirmation on this next move up? Nope. The price closes above the previous high again, and there's no sign of rejection at this level. So no trade yet. I'm still just waiting. So what I'm waiting for is this. After the market pushes down, I want to see it come back up to that same level. And this time, I want to see rejection. That rejection shows up right here with this red candle. That's my signal. Now let me walk you through my exact rules for a valid double top entry. I'm looking for the market to push up and land somewhere between the top of the wick and the highest closing bodies from that earlier move up. That little zone between the wick high and the body highs is what I call the rejection zone. So here's how I define my rejection zone. It's the area between the highest closing bodies of the previous swing high and the highest wick from that same swing high. What I want to see is this. Wicks of candles can touch or enter this zone. Bodies of candles can close within this zone, but I do not want to see a candle close above the top of this zone, because when candles are closing above it, like we saw earlier, that's not rejection. That's the market pushing higher, not showing signs of turning. What I'm looking for is a wick or body to enter that zone, and then a red candle to follow. That's my signal that sellers are stepping in and trying to take control. When you put all of this together, you're aligned with the higher time frame trend. The market is pulling back into a major swing level that was previously broken, a key structure zone. You get a clear and objective entry signal, like a double top with a strong red candle showing selling pressure. You now have a complete strategy that's built on rules at every step. And rules create consistency, which is the foundation of successful trading. This kind of setup gives you a real edge in the market, not just once or twice, but over a large number of trades. From my own experience using this exact strategy for almost 10 years, I can honestly say it's been one of the most reliable and profitable approaches I've ever worked with. And as for how this trade turned out, well, you already know it was a beautiful setup, but let's hit play and watch it one more time because it's always satisfying to see it play out. Earlier, I said it took about 2 hours, but in reality, it wrapped up in closer to 1 hour, ending with around a 2.4 to 1 reward to risk ratio. Solid outcome. This example showed you the bearish version of the strategy, and I hope it was super clear and easy to follow. Now, just to make sure everything clicks, and to show you how this strategy works in the opposite direction, we're going to switch over to a different chart and walk through a bullish version of the setup. I'll see you there. Remember when I said this strategy works across all markets and all time frames? Well, now we're going to look at a trade setup on the 15-minute chart. So quick quiz, what time frame should I use to spot the trend for this trade? If you said the 1 hour chart, you're absolutely right. When trading on the 15-minute chart, I look one time frame up to the 1 hour to find the trend and the last major swing level that was broken. And I really want to stress this point. Understanding major swing levels and how to properly identify trends is crucial to your success as a trader. Whether you're using a rule-based strategy like this one or trading more discretionarily, knowing how to spot major swing structure will be a core part of almost any trading approach you use going forward. You've got to understand how to identify trends. It's one of the most important skills in trading. So starting from this point on the chart, here's what we see. A push up to a major swing high, then a pullback to a major swing low, another push up to a new major swing high, followed by another pullback to a major swing low, then another push up. Now, where do we break a previous level? And by the way, don't hesitate to draw horizontal lines on your chart to mark your major swing levels. At this point, we can mark this spot as a major swing level. If the pullback had been deeper, maybe we'd adjust a bit. There's no perfect way to make this 100% objective. Some of it comes down to how you read the market. From here, I draw my line from this high, then move it up as the market pushes further. Eventually, we break a major swing level up here. That's important. So now we've got a move up to a major swing level, a pullback to an equal low, and that sets our next major swing level. Now let's move things forward a bit. Where do we get the next break in the market? Right here. Once we break this level, that tells me this is now our new major swing high and the low before it becomes our new major swing low. So what do we have now? We're clearly in an uptrend. And if we're in an uptrend, what direction should we be trading? To the upside, of course. Now, what's the next thing we need to do? We need to mark our zone, the area near our last level of resistance, which is our last major swing level. In this case, we have two swing highs that are very close in height, so I'm combining them into one zone. That'll be the area I watch for the market to pull back into and possibly show signs of rejection for a bullish trade setup. Since both of those swing highs are really close, around the 278 mark, I'm just placing my zone right in the middle. That's how you need to think about support and resistance. They're not perfect lines on a chart. They're zones. So in this case, we've marked the previously broken major swing level, and we're splitting the difference between the two highs because they're so close together. Now the market is pulling back into that zone. What's the next step? At this point, we drop down to our trading time frame, which is the 15-minute chart in this example. And now we're ready to look for a setup. Since we're planning a bullish trade, we're not looking for a double top. Instead, we want to see a double bottom. So here's what we need: a push-up, then a pullback into our zone. And finally, we want to see the market reject that area, giving us a signal to go long. Somehow, some way, the market needs to come down and show us rejection of that zone. How do we spot that rejection? Simple. We want to see candles enter the zone, either wicks dipping into it or bodies closing inside it, followed by a green candle, which shows buying pressure stepping in. So as we keep moving forward, we see price enter the zone, stay in the zone, and boom, there it is, a solid green candle. That's our entry signal. I would enter on the close of that green candle or the open of the next one. Either works. From there, I place my stop loss just below the lowest low of that double bottom rejection area. And for my target, I'd aim for the previous resistance level, right around here. I'd probably choose the lower of the two nearby resistance zones just to be a little more conservative. That gives us a nice setup with a 2.3 to 1 reward to risk ratio on this Litecoin trade. Let's see how this trade plays out. As you can see, the market takes off to the upside, easily hitting our target. A clean and successful trade using the bullish version of the strategy. Now, let's dive into a recap of everything we've covered, using a fresh example on the Microsoft chart. Like I mentioned earlier, this strategy works across all types of markets and all time frames. And now we're taking a look at it on the 4-hour chart. After the recap, I've got something really important to share, especially for those of you who are serious about starting a day trading career. But first, let's review the full strategy step by step and apply everything we've learned so far right here on Microsoft. So, let's walk through this setup on Microsoft. Starting from the very beginning, we start at this low point right down here. From there, the market pushes up to a major swing high, then pulls back to a major swing low. It pushes up again, then pulls back. Now, when do we break above this previous high? Right here. And that gives us confirmation of a continued uptrend. Then we get another pullback, followed by a move up to a new high, which forms our next major swing level. At this point, what's the trend on the 4-hour chart? We're in a clear uptrend. And remember, we're going to be trading on the 1-hour chart, so the 4-hour is our higher time frame. Now, what's the most recent major swing level that got broken? It's right here, and that's the zone we'll be watching for a possible pullback and entry. So, this is the latest major swing level that's been broken according to the rules of the strategy we've been using. Now we're seeing a pullback into that level, and that sets us up to look for a possible trade. Since we identified the trend and structure on the 4-hour chart, that means we now drop down to the 1-hour chart to look for an entry. And just to quickly recap how this time frame setup works, because it's key to the whole strategy. If you're trading on the 5-minute chart, you look for trend and structure on the 15-minute. If you're trading on the 1-hour chart like we are now, you look to the 4-hour for the bigger picture. And if you're trading on the 4-hour chart, then the daily becomes your higher time frame for structure and trend direction. Simple, consistent, and easy to stick to. Now let's drop down to our trading time frame, which in this case is the 1-hour chart. What are we looking for here? Since this is a bullish trade, we're looking for a double bottom pattern. And yes, this setup meets all the rules. We get a push down, the market forms a bottom, then it pulls up, creating a neckline. And finally, we get a retest of that bottom. But notice the candle doesn't close below it. That's a sign of buying pressure. Then we get a green candle, followed by an even stronger green candle. And that's our entry signal. I would enter on the close of that strong green candle. For the stop loss, I place it just below the low of the double bottom. To fine-tune that stop, I use something called the ATR, Average True Range Indicator, which helps account for market volatility. The ATR indicator is right up here on the chart, and what it tells me is that the current average true range is $2.31. That means, on average, the market has been moving about $2.31 per candle over the last 14 candles. ATR helps us stay aligned with market volatility so our stop loss isn't too tight or too loose. So, how do I use it? Let's say our swing low, the bottom of the double bottom, is at 185.90. To place my stop loss, I simply go 231 below that, which brings me to around 182.89. Even if it shows 182.92 is on the chart, 182.89 is close enough. That's where I'd set my stop. For the target, I want to aim for the previous resistance level, which is right up here. That gives us a solid structure-based exit point. So I set my target at the previous major swing high, and when I hit play, you can see the trade eventually pushes up and hits that target. There was a small gap down at one point, but it didn't even come close to hitting the stop loss. The trade held strong. And there you have it, a full recap of every part of the strategy in action. Hopefully that was enough to help you fully understand how the strategy works from start to finish. But here's the thing, the strategy alone isn't enough. Now, I want to share something extremely important, especially for those of you who are serious about becoming consistently profitable in trading. It's called the triangle of trading success, and it's something you absolutely must master. If you haven't heard of it before, the triangle of trading success is made up of 3 essential skills. And here's the truth. It doesn't matter if you're a day trader, swing trader, or even a long-term investor. If you want to make money in the financial markets, you need to have all 3 of these skills dialed in. Everyone who succeeds in trading has mastered these. The first part of the triangle, and what we focused on today, is having a strategy that you can stick to, one that's rules-based, consistent, and profitable over time. This is a huge piece of trading success, but it's not the whole picture, not even close. The second part of the triangle is just as important. You need a solid risk management plan. Why? Because risk management helps you stay out of your emotions, avoid overtrading, and, most importantly, protect your capital. The strategy we just went over, for example, wins about 50% of the time, slightly under actually, but it uses a 2-to-1 reward to risk ratio. That means even if you're right only half the time, you're still profitable in the long run. That's what gives me an edge, and that's what makes it a money-making strategy when applied consistently over time. But here's the thing. If I take that strategy and risk my entire account on the very first trade, then I've basically turned it into a coin flip. I've got a 50-50 chance of blowing up my account. That's not trading, that's gambling. This is exactly why having a risk management plan is so important. It's what keeps you in the game, kind of like having chips in a chair at a poker table. It gives your edge time to work over a long series of trades, because even a winning strategy won't help you if you don't survive long enough to let it play out. So the key is this: your risk management plan should be designed to protect your account, especially in the beginning. Will it remove all risk? No. But it will reduce the chance of blowing your account by 99%, and that's exactly what you need to stay in the game. The second purpose of a risk management plan, beyond just protecting your account, is to keep you out of your emotions. It helps prevent fear and greed from taking over when you're placing trades. So how do we do that? By making sure the amount you risk on each trade is small enough that if you lose, it won't rattle you emotionally. Because here's the reality: you will have losing trades, I do, and so will you. That's just part of trading. The key is to not let those losses get in your head. If they do, you're more likely to make emotional decisions. And that's when you start breaking your rules, chasing trades, and destroying your edge. And along with it, your money-making strategy. But here's the thing. None of this matters. Not the strategy, not the risk management. If you don't have the third piece of the triangle of trading success, trading psychology, also known as discipline, this is what allows you to actually stick to your strategy. It helps you avoid FOMO, keeps you from strategy hopping, and stops you from doing things like overtrading or revenge trading after a loss. You know the feeling. You get stopped out, get frustrated, and suddenly you're placing a bigger trade than usual, just trying to make your money back. That's where things fall apart. And that's why mastering your trading mindset is just as important as any technical skill. All of that, the overtrading, revenge trading, risking more after a loss, those are emotional mistakes, and they all come from having poor trading psychology. So if you're serious about building a profitable trading career, this is something you absolutely must master. That was a little bonus breakdown of the other things you need outside of just having a good strategy. Because true trading success is built on more than entries and exits. If this video helped you, make sure to like it and subscribe to the channel so you don't miss future content. And if you want to see a step-by-step breakdown of another strategy, or you've got a specific topic in mind, drop a comment below. I'd love to hear from you.